Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about your first investment if you're new to investing. And it's okay. It's okay to start investing. And so we're doing this video not just because it's for the newer investor, maybe it's for the more experienced investor or the investor from last year who invested in some meme stock or some sort of that and lost money and then just completely stopped investing and was like, I can't make money doing this, blah, blah, blah. And so if you're new to the channel, welcome. This is where we put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so I'm not going to go through the portfolio or whatever. You can check out the last video. So if you're new to investing or you had a bad experience last year, the number one investment I think you can make is in an index ETF in the S&P 500. And I want to talk about a very specific one, which is ticker symbol VFV, which is the Vanguard S&P 500 index fund, which is not hedged. If you are looking for a hedged version, you can go ahead and check out the other video that I did a comparison with these two. And so if you're new to investing, I think the best thing you can do to start learning about investing is just do a broad market index fund in the S&P 500. And what is that? The S&P 500 is a fund that started in 1926 and tracks the top 500 companies in the US. In 1926, it only actually had about 90 stocks in there, and then it just grew to 500 as America grew, and they included the top 500 companies. And how it works is it's weighted. It's not your dollar goes into, let's say you put in $1 and then whatever that is of divided by 500 goes into each company. It's weighted. So you might have a little bit in Apple, a little bit in Microsoft, and you might have 2% in Apple and 5% in Microsoft, and so on and so forth. Might be the other way around, probably is. And it's just weighted. So it's distributed between the top 500 companies. And so how do they decide which are the top 500 companies? It's based on market cap. It's based on a bunch of criterias, but there's also a board that decides who gets in and who gets kicked out, right? It's kind of like a leaderboard. If you're not in the top 10, you're out. It's kind of like in golf. If you're not in the top 5 for the final or the top 30 or whatever it is, you're out of there, and they bring someone else in. That's how the S&P 500 works. And why the S&P 500? Because, and why not like a Canadian TSX 60? Because I just believe that the US just has way more companies, and just a lot of them billionaires come out of there, and the leaders in companies continue to grow things. Like Elon Musk, for example, brought Tesla into the S&P 500, and he continues to just put everyone in awe, especially Wall Street and institutions, by just what he's doing. Since 1926, the S&P 500 has done an annual return on average, roughly anywhere from 10 to 11%, and that's up to 2018. I don't know what the numbers are for 2019, 2020, 21, 22. I know this year, or sorry, 2021, the market S&P 500 did do a 28% return. And so what does that mean for you? Well, let's go and look at VFV first. So we'll go ahead and switch over. We'll head straight to the Vanguard site, and this is the fund that I'm talking about, VFV S&P 500 Index ETF. There is a management fee. However, this management fee is much less than what a traditional mutual fund does or your professional advisor will advise, okay? Their fees are a bit higher. They're looking close to the 1 to 2 to even 3% of what your money is going into as a fee. This is just a management fee of 0.08%. So for every $1,000 that you can get into this fund, they will take 80 cents. Not bad. As you can see, if we go to year to date, we'll go 1 year, starting January 4th to now, you can see a big, huge from $83 right up to $106. And of course, this is Canadian non-hedged, so it does fluctuate with the US dollar. Now, this is how it's breaking down. Remember how I was talking about how it's weighted? 29% of it is in IT, which is tech, 13% in consumer discretionary, 12.7% in healthcare, financials is 10.8%. So it's all like that. And you can see, so how I was talking about Apple, 6.641% will be in Apple of your money. So let's say you put in $100 $6.64 will go to Apple. $6.36 or 35 cents will go to Microsoft, and so on and so forth. And you see the breakdown. You can see all of the listings. There's 507 apparently. And you can buy this right on Wealthsimple Trade. And speaking of Wealthsimple Trade, if you haven't used the link down below, you can get a free stock once you fund your account. So go ahead and use that link below. This is the #1 fund I believe, in my opinion. And again, I'm not a financial advisor. I'm just a guy on YouTube building a dividend portfolio right in front of your eyes. And this does yield you a dividend. I think it's about a 1.2% dividend yield on this one on a quarterly basis, and it'll continue to grow. Let's look at what the numbers are. And I'm going to do this year as well. For every time we make a purchase in our dividend portfolio, I will add $25 and I will buy fractional shares to show you guys the progress as well. I will do it with you. But of course, everyone has their own idea. Like, they don't have to do $25 a week. They can do $25 a month, but you should start investing because it will yield you quite a bit. Now, initial investment, we're going to start at $0, but you're going to do a monthly contribution of $25. That's it. That's less than $1 a day. Anybody can do this. I sound like an infomercial. Anybody can do this. Less than $1 a day. On less than $1 a day, you can invest and you can start making returns. Okay, 1 year estimated return 10% because we're using the average on the S&P 500 since 1926. We'll go ahead and calculate that. It's only going to be $300. Now you're like, why? Didn't even grow, because $25 times 12 months is $300. This calculator does not take into account the gains you will get as soon as you put in that $25. Then you keep on doing that. 1 year, you might make $330. Okay, whoop-de-doo, $30. But remember, you have to do this to scale. And I don't know what your situation is. I don't know if you can do $25. Maybe do $10. Maybe do $25 every paycheck. But let's bump it up to 2 years here. Okay, and we'll go ahead and calculate that. And you'll have $630 because of that 10% return. You put in $600, they'll give you $30. It might be a little bit more than that because they didn't take the first year into account of all the returns you'll get throughout the year. Let's go ahead and jump to 10 years. Now, if you're going to keep on doing $25 a month because that's all you can do, that's fine. Okay. As you can see here, in 10 years, you will put in $3,000, but the future value based on a 10% average should be $4,781.23. That's $1,700 that you didn't have before. That is literally in value that you could take out if you wanted to, but I don't suggest you do. You just leave it in there and let it keep on compounding over and over. Now, if you're 18, you probably have 47 years to invest, and you're putting in $25 a month. Boom, look at that. $261,000. That's compound interest right there. You would put in yourself for the next 47 years, because I'm taking into factor the average age of retirement in Canada, $14,100 of your own money, and your value of the S&P 500 at retirement would be $261,592.46. This is all scalable. It's not gonna happen overnight. Investing does not happen overnight. I know that we see it all the time, that people make millions overnight and so on and so forth. If you want to do that, fine, you can try it. But this should be a part of your portfolio. Whether you have a crypto portfolio, whether you have a real estate portfolio, you should do something in the stock market. And here it is, my #1 recommendation. Again, I'm not a financial advisor. Now let's just bump it up to $50 a month, because I'm sure you can spare $50, right? $28,000, $200 is what you put in. Your return will be $523,000. That's $500,000. Now, people tell me that they can't be millionaires in Canada, that it's impossible, that they don't want to invest because they just lose money. But it takes time. You might not see a big growth in the first 10 years. You might see a little. Like, you can look at the graph right now. There's not such a big gap. But once you get into the later years, it just starts exploding exponentially. Now let's just go to $100 because you can. Here it is, $1 million. Okay, $100 a month will yield you $1 million at retirement. How could you not be a multimillionaire in North America? It's totally possible. The greatest thing about the tax-free savings account, though, is you can put in $500. Let's just go 500. Okay, $500 a month, because every year it's $6,000 based on the age that you are when you turned 18. You can put in $6,000 for 2022, I believe. And so if you calculate that, let's just see the big number here. Exciting stuff. 47 years, you will have $5.2 million roughly And this is based off a 10% return. Now, not every single year is going to be 10%. One year might be 2, last year was 28, this year, who knows what it could be. But you just keep on investing, you keep on putting money away and invest it. Don't just save money, invest your money, because inflation does happen. And every year you don't invest is a year that you're missing out on buying power, you're missing out on growth, and you just continue to sit on the sidelines. And before you know it, you're going to be 47, you're going to be like, investing doesn't work. And somebody at the Thanksgiving table who's 18 is like, I started investing, and you're going to tell them not to, and so on and so forth. You've heard the story. It's just how it goes. But the S&P 500 in a tax-free savings account, you can do, okay? And I'm going to do it with you guys as a accountability thing. And so we'll head back to here, and I already have VFV on the watch list here. It's down $1.17. So you put in 25 bucks, you're down $1.17. Whoop-de-doo, just leave it in there, because it'll grow. Like I keep on saying, for the 1 year, 23%. Okay, so 23% was the 1 year, or sorry, $23, 27.43% for the 1 year. And you can buy fractional shares of this, and I'm gonna do it with you guys. So every single week that I make a purchase in the old dividend stocks that I can normally do, I will put in $25 every single week into the S&P 500 VFV fund, and we'll track it for the year, and I'm gonna do fractional shares. You don't need a lot of money to invest. You just need to put something away, and like I said, on less than $1 a day, $25 a month, 83 cents, I think it is, 83 cents a day. You spend more than that on a coffee every single day. I know you Tim Hortons drinkers go out there and buy a $2 coffee, maybe even twice a day. That's like $4. You can put that away and start saving for your retirement, start putting money away and investing it, so that in the future, you don't have to worry about CPP running out, EI, or old age security. You can start building your future now. And this is the #1 way to do it, in my opinion. If you want to invest in the TSX, go ahead. But in my opinion, the S&P 500 is just where it's at. And no one tells you about this. Schools don't tell you about this, but I think that's going to change with the new generation coming up, becoming teachers. Maybe they're investment savvy. And crypto is another one. I have a small portion in crypto. I have like 3 graphics cards mining it. I've never put money into it, but I'll continue to mine it probably for the rest of my life until it does something, because I'm sure it will do something. And so that's pretty much it for the video, guys. The number one investment, in my opinion, again, this is not financial advice, is the S&P 500. In here, VFV, the non-hedged version, which works with the dollar. So if the US dollar goes up or down, great. Hopefully you guys did enjoy the video. Don't forget the link down below for your free stock once you fund the account. Don't forget to subscribe, completely optional, but completely free. And also don't forget to hit the like button. If you don't like the video, just hit twice. You just hit it once to like, and then hit it again and it doesn't like. That's how that works. Starting next week, when we make a purchase, you'll see that I'll be purchasing fractional shares. And again, if you sat on the sidelines, here's to start again. It's a new year. Make it a goal, $25 a month, less than $1 a day. I just got to emphasize that. So if you did enjoy the video, don't forget, leave a like, and we'll see you in the next one. Bye.